Right, hi everyone. I'm going to do a quick video on 3 reasons why Ranmore doesn't own mega cap tech, and it was a substantial reason as to why we outperformed the market so meaningfully last year. Let's kick into it. Right, first point, and all the disclaimers are at the end. Advertising has been a key industry growth driver. Okay, this is revenue growth of the major players extracted from the annual reports, and back in 2015 you had Google, Meta, Microsoft, and Twitter, almost 100 billion. Now, who do we have at making up nearly 400 billion? We have Google, Meta, Microsoft, Twitter, same lot. Amazon, TikTok, Apple, Pinterest, Snapchat. Of course, now Netflix has started their advertising tier. Plus, you've got Disney, and then we've got all the other channels. Excuse me, plus. Okay, and advertising is under pressure. This is what the chief business officer said in October for Alphabet. We saw a pullback in some advertisers in certain areas, insurance, loan, mortgage, and crypto subcategories. And that makes complete sense. Mortgages have gone up substantially in the US. Crypto has collapsed in a heap. That hasn't come back in the fourth quarter. And so you're going to see muted demand there. Meta, they said, we've seen weak advertising demand continues to be impacted by the uncertain and volatile macroeconomic landscape. Well, that hasn't really changed, okay? The CFO of Microsoft said reductions in advertising spend, and here's the rub, weakened later in the quarter. Now, this comment was made on the 25th of October, which is in the new quarter. Did they say anything about the new quarter? Not that I picked up. Okay, so what chance is it that all of a sudden it is rebound? I would suggest pretty low. This is what the Amazon CFO had to say. We saw good growth in our advertising offerings. Our advertising is at a point where the consumers are ready to spend, and so we have lots of advantages. And that's the interesting thing. So even though it's tough, there are 1 or 2 competitors that are doing okay, making it even tougher. Right? And it's possibly getting worse. This is these are some headlines from the Wall Street Journal. Google and Meta's advertising dominance fades as TikTok streamers emerge. When was that made? January the 4th. Biden calls for limiting tech companies' use of personal data in targeting advertising. When was that? Article written on the 12th of Jan. Twitter offers free ads as it seeks to win back advertisers. Okay, when was that made? 13th of Jan. So the few advertisers who left are now getting fought over. Okay, and there's one new thing. What is this? Recognize this? This is ChatGPT. When was that launched? 30th of November. I went on to go and have a look, see what the excitement has been. If you don't know what ChatGPT is, go and have a look on some of the YouTube videos. Jordan Peterson writes it was got a pretty interesting one. ChatGPT is a capacity right now. Now, this is effectively a search. You can ask ChatGPT lots of questions. You don't have to go through ads. So could that be a challenge to the industry? Quite possibly. It's certainly not going to make the industry any better. All right, so that's the first reason. All right, second reason is employee growth is a problem. And this is across the industry, really. What we've got here is trailing 12-month revenue, so last 4 quarters, and it's rolling. And this is revenue growth, percentage growth on the right, and this is for Alphabet. And you can see that during the pandemic, revenue accelerated. Now, what I've then done is I've overlaid the average number of employees to have a look and see what has revenue growth done and what are employee numbers done. And what you can see is that when the pandemic, you saw revenue accelerate, okay, but employee growth, the growth in employee numbers was slowing because it was tough to find people, and then the companies started to invest. Now, what happens, do you think happens, when you have a situation where revenue is accelerating and growing much faster than your employee numbers? Well, what I've got here is operating margin, and not surprising, Google's operating margin went from 20% to 30%. Okay, and now, of course, you've got a 30% operating margin on revenue that's up 40%. So you can imagine what the impact is on profits. Now, what has revenue done more recently? Well, what we've got here on the far right is that is what trailing 12-month revenue will be if analyst forecasts are correct. And of course, most times analyst forecasts are optimistic. And so when you've got revenue decelerating and in fact going negative, and you've got employees, because there's always a bit of a lag, okay, you sign somebody on, they've got to spend 3 months gardening, and then they come and join you, and employee numbers are flat, so you've got employee numbers still growing 15% and revenues declining. What do you think happens to operating margins? Okay, well, that's what analysts think. They think it's going to still be higher than where it was back then. I would bet a lot lower. All right, so that employee growth is a real problem. The third reason is they're still expensive. So we got the market caps along here, billions of dollars, so 1.7 trillion, 2.1 trillion, free cash flow of 63 billion. And this is the commonly calculated method of free cash flow. It's the operating cash flow minus the capex. And you've got a free cash flow yield of 3.5%, 5.2, Amazon's negative, Google 5, and Meta 7. And you go, well, you know, Meta's very attractive. Isn't Meta cheap? Okay, bearing in mind that your 10-year bonds are now 3.5. The problem is that this free cash flow calculation assumes that employees cost nothing because it adds back stock-based compensation. Now, stock-based compensation, employees are rewarded in shares, and any movement in shares happens in the third part of the cash flow statement. If you repurchase shares, if you issue shares, etc. And so there's a very good argument to be made for the fact that stock-based compensation should sit down there in the third section of the cash flow statement, which would ensure that you're not assuming that employees are costing you nothing. So let's take the SBC, all right, and subtract that from the free cash flow and calculate a more realistic yield. And what do we get? 3.5% for Microsoft, dropping to 3.1, 5.2, 4.8. Amazon goes more negative. Google or Alphabet 5.2, 3.7. Why? Because they've got 18 billion in stock-based compensation, and Meta drops to 4. Low rates, very low yields, especially if conditions are getting tougher. Okay. I'm going to give you an extra bonus reason. What we've got here is the QQQ, the NASDAQ 100, and it's rebased to 100 back in 2017. And so this is the price of the NASDAQ 100. You can see it accelerated after the pandemic, or during the pandemic, and it is down some 30% from the highs. Now this is an ETF, and you know, if you want to buy shares, they'll issue shares, and so you can get the number of shares outstanding, and I've overlaid on this chart the number of shares outstanding. Now, what was interesting is that as the price was falling of the QQQ, okay, the fans didn't lose faith, and they thought this is an opportunity to buy these wonderful companies at a lower price. And so the number of shares outstanding increased, betting that maybe, I don't know, maybe they were betting that interest rates or inflation was going to slow, etc. Until recently, and that is despite this little kick up in the QQQ. And this suggests to me that finally the penny has dropped. Okay, finally the penny has dropped, and that the answer to tech is not worrying about inflation. It's not worrying about interest rates. It's the fact that the outlook is deteriorating and these companies do not offer value. And now we're starting to see the selling. Okay, so last thoughts. If revenue growth is slowing or falling while costs are rising, what do you think earnings are going to do? They're going to fall. But if valuations are already stretched based on unrealistic estimates, and the balance sheets no longer offer a margin of safety because they've spent a lot of money buying back stock, and people decide to sell, who are the buyers going to be if everyone already owns them? Okay, and that could be what you're going to be looking at. So if you learned something and you enjoyed it, like, comment, and subscribe. It's meant to be informative. It's not advice. Do your own work. Read the disclaimers. Email clientservices@ranmorefunds.com if you'd like a copy. This is where you can find our fund. Go and have a look at Morningstar or the Financial Times if you're looking for more information, and get in touch and hear the notes and disclaimers.